Good morning, everybody. My name is Clark Schweitzer. I'm a senior wealth advisor here at Diversified. I am joined by an esteemed colleague and host of today, Scott Lavelle, our Chief Investment Officer. We hope everyone's been having a great summer so far, enjoying time down the shore or traveling about with family and friends. We got a lot to unpack today with kind of the latest and greatest of what's going on, both domestically and abroad. I'm sure everyone's been hopefully keeping up with what's been going on here, and Scott's going to give us a great overview of kind of where we've come to this point. But without further ado, I'd like to introduce Scott Lavelle, Chief Investment Officer here at Diversified. Scott brings 25 years of investment experience. Most recently, he was Managing Director and Head of Investment Advisor Research and Investment Product at PNC Asset Management. He led a team of 45 individuals there, overseeing about $80 billion of assets. Recognized across the industry, institutional investor. He currently holds his CFA, which is a Chartered Financial Analyst, a CAIA, and an FRM designation. So much smarter individual with investments than myself. So I will let him take it from here and share what's the latest. Scott?
Thank you so much, Clark. I appreciate the introduction, and it's a pleasure to be with all of you this morning. I appreciate you all spending time with us today, particularly in the summer months. I know your time is valuable, so I'm going to keep this to about 15 minutes, focus on what's most relevant. I'm about 2 months in. I've spent that time getting into the portfolio, preparing for this conversation. I'll review the big themes of the quarter, provide a bit of an update on our positioning, and also what we're watching. I'll do all of this through the lens of our philosophy on investing. All right, so in the spring of 2001, a Pentagon official named Lynn Wells was given an assignment. The Defense Department was doing its big review, and he was asked to weigh in. What are the state of affairs? What should we focus on? He could have come back with the forecast. He had all the clearances. He had a big budget. But instead he wrote a one-page memo to frame his thinking, and that's what's on the screen. And it goes through the decades of the 20th century. So 1930, the official defense planning standard said there would be no war for 10 years, and 9 years later, World War II breaks out. You fast forward, 1980, America is the greatest creditor nation in the history. 1990, we're the greatest debtor nation. And almost nobody had heard of the internet. The important piece is his conclusion. It was the last bullet on his memo. It said, I'm not sure what 2010 will look like, but I'm sure it will be very little like we expect. So we should plan accordingly. And that's the theme of our philosophy. And if you notice about what Lynn Wells did, he was asked for a prediction, but he gave a plan. He didn't say the future is unknowable, so we should give up. He said the future is unknowable, so we should build for that. So in the quarterly review, I'm going to do a little bit of what Lynn Wells did. I'm going to show some predictions, including ours, and then I'll explain why we plan and position portfolios so we don't have to have the right prediction. So here's Wall Street's version of the list I just showed. This happens to be recent history. This is, if you look on the left-hand side of the slide, these were consensus Wall Street predictions in January of 2026. These are experts who have enormous research budgets. 1 to 2 interest rates were predicted, but inflation would be cooling. We did get a good print yesterday. And you read down the list, and a lot of those predictions in January turned out to be a little bit misguided. Things evolve, so going from 1 to 2 interest rate cuts as the consensus prediction, now consensus is expecting 1 hike instead of cooling. Inflation did peak. Again, we got a good print yesterday. But the point is not to say that forecasters are foolish. The point is that it's just extraordinarily difficult to predict the future, and the world changes. So in April, when we last met, this is what we said. Stay invested. So April, if you recall, there's a point the S&P 500 was down 4.3% on the year. Our guidance was to hold. That was probably the most important guidance looking back, was to stay invested. And I want to be clear that that wasn't us calling the bottom. What it was us being disciplined and sticking with the plan that we had put in place. We also said the Iran war would be inflationary. That showed up. We had previously put tips in the portfolio to help hedge against inflation. Earlier in the year, we did increase our emerging market exposure. That's been a very strong performer. We too thought the Fed in April would be a tailwind. We thought we were expecting rate cuts. That hasn't hurt us because earnings, rather than the stimulative effect of lower interest rates, has driven equity returns. And while we still favor US over international, and international, including emerging markets, has outperformed, we did make that increase in allocation to emerging markets. The key point that I want to make showing these predictions is when I think about, or when I open with that memo, it's not just about the Pentagon or war planning, it's about anyone who has to act without knowing the future. This is what's called being a decision maker under uncertainty. And that's what we are. So briefly, I'm going to run through some of the big themes of the quarter, what it's meant for our positioning, and what we will be looking at as we go ahead. So we all know Iran geopolitics. February 27th was the day before the war starts. This chart shows where oil was before the war started. It peaked around 120 in March. At the end of June, retraced much of that back down to about 72. It's roughly $79, $80 today. The point there is, although oil went up, came back down, inflation continued to rise as measured by CPI. Rates went up, and at the time, this was at the end of the quarter, June 30th, expecting one rate cut. Through all of this, the equity market has been incredibly resilient. We've recorded 24 record highs in the S&P 500 this year. Throughout this volatility in oil, this uncertainty and volatility in geopolitics. And so in the next two slides, I'll talk briefly about what's been powering the market, but also why inflation isn't just about oil. AI build out, as you all know, it's a big theme in the market. The amount of money that's being spent, it's really kind of hard to wrap your head around it. What I'd like to show in this slide is that there's a handful of companies that are spending a tremendous amount of money on the AI build out. And what's evolved is that 2023, the bar shows the amount of money that they were spending on the build out, generating from their own cash flows and what was left over versus today. What's happened is the gray piece, which is the money left over from the cash flows, has shrunk. They've been spending more of the money they generate to build out, and they've started to borrow. They've become issuers of debt. And I'm not saying debt is bad. What it means is that debt does have a due date. So in some ways, it starts to put a clock on the return. This is just something that we're watching. But the big question for the market is, what will the return be of all of this money that is spent on the build out? No one yet knows, but this is a key question that we're asking, and it's a key component of what has been driving a lot of activity in the markets. This slide shows there's a lot of capital spending that is occurring in addition to the AI infrastructure build out. The numbers are staggering. This spending has been a reason or a piece of how the spending has trickled down to help earnings in companies across the equity markets, but it's also been part of what has driven inflation outside of oil. And to try to make these numbers a little bit more concrete, I used some examples. So for example, the spending on the energy and grid, the rearmament of NATO, $1.4 trillion spending on reshoring. Just the spending on the build out of the energy and the grid, that's the equivalent to the entire economy of Italy. And all of this spending is competing for the same things: concrete, copper, electricity, financing. And so this is why it's inflation isn't just about oil, but it also is being spent, and other companies within the equity market are benefiting. It's happening across sectors. It's not just an AI story, and this is also why diversification matters. And speaking of diversification, it's our name. But one thing to keep in mind, you're diversified when the investments in your portfolio behave differently. If they all go up at the same time, at some point they'll most likely tend to go down at the same time. So when you're diversified, you have some investments that perform better at times than others. I show here US large cap, US small cap, and emerging markets. And if you looked back at the past 5 years, US small cap and emerging markets had underperformed US large cap. This year in 2026, smaller companies measured by the US small cap, emerging market, equity markets have significantly outperformed US large caps. We have exposure to both small caps. I mentioned we increased exposure to emerging markets early in the year, but I use this to illustrate that when you're diversified, your investments will perform differently at different times, offset each other, reduce the volatility, but also provide a greater opportunity set to your portfolio over time. So here's what we're watching in the second half of the year. So the June CPI printed the morning of the 14th, a couple days ago, was 3.8%. So lower than what I'm showing on this slide. This slide was the June print. Inflation is still elevated, but the rate of change is declining. That's a positive. So we'll be watching if this most recent print is a one-off or if it's the start of a new trend. We do have some tips in the portfolio to help provide resiliency to inflation. We'll also continue to be watching geopolitics and oil. That's one reason why we've made an allocation to dividend-paying companies. They tend to be more mature and resilient. So if there are shocks in the economy or world, having exposure to those more mature and resilient companies is beneficial. I mentioned AI, we'll be continuing to watch that. What the return is, that is something that will be playing out over a longer period of time. And there are midterm elections coming up later in the year, and we'll be paying attention to that. I want to note, like with these questions, and they are questions, they're not predictions, this is where our diversified exposure helps us, because our investment outcomes, they're not predicated on getting prediction on any of these questions right. And keeping in mind that memo that Lynn Wells wrote, that's why these are questions that we are asking ourselves and monitoring, and not a list of predictions. But I did want to note, speaking of predictions, so inflation is a big topic, and I just want to show this because I was reviewing information from across Wall Street. These are, again, experts, and they're looking at the same data, coming to different conclusions, and that's occurring even within two different entities within the same firm. And I don't say any of this as a criticism. I just point this out that it's just an honest state of knowledge to not know the future. So you have some Wall Street experts who believe that inflation will fade, and you have others who believe it will stick. For us, if inflation comes down, rates stay in place or move lower, the bonds in our portfolio will benefit. That should be a positive for equity markets as well. If it's sticky, we did add some inflation protection, and the way or the pattern of things has been that it has been beneficial to earnings So actually supportive of the equity market. But the point I'm making is that we are diversified. We're positioned in some ways with both outcomes in mind. And it's not because we're being indecisive, it's because we're having a plan and we're managing risk. So our outcomes are not dependent on any one outcome. So when I opened the meeting with the memo, that was a century of expert predictions being wrong. This is just a similar list today. It's just in the middle of the argument. We'll find out in the future which half is wrong or right. So one last thing about Lynn Wells. So that memo that we looked at to open, that was the cover for the full report that was delivered to Congress. It was delivered to Congress on September 30th, 2001. It's 19 days after the future it was planning for had changed. What's interesting is what the Pentagon did next. They didn't hire better forecasters. Instead, they changed the question. The 2000 review shifted the military away from what they call shifted to capabilities-based planning, away from threat-based planning, which means that they stopped building around a specific enemy they could name or forecast, and instead started building capabilities that were broad enough to handle different threats, uncertainties, different outcomes. I think it's interesting that the institution with the largest intelligence budget on Earth looked at its own forecasting record and concluded that the answer wasn't better predictions, but instead it was creating a structure that didn't need to rely on predictions for success. And at the core, that's our portfolio philosophy. Take a page out of Lynn Wells's memo. The future may be very different than what we expect, so we should plan accordingly. That means that we're building portfolios that don't require us to be right on a prediction. We're building them for resilience and different outcomes. We prepare, we don't predict. So that concludes my prepared comments. I'm happy to answer any questions. And again, I really appreciate all of you spending time with me today.
Thank you, Scott. We appreciate the insight as well as the brevity of this mid-year update here. And yeah, I think it's important as all of you out there listening and thinking of your own situations and how you're positioned with us and working with your advisors and your planners here, assessing some of those decisions, right? Making sure you're properly allocated because the primary determinant of risk at the end of the day is not timing the market. It's not always investment selection, but it's asset allocation. And it's making sure that you're properly allocated, not trying to guess what the future might hold, to Scott's point, but it's to be prepared for what the future might hold. And, that asset allocation is extremely important to kind of get right and to refine as your lifestyle changes, whether you're coming into retirement or in retirement, or as you see inflation creep up in your own lives and things that used to cost a fraction of what they are today is eating into what you thought could be a vacation budget or gifts for the grandkids or whatever it might be. So it's important to reflect and share that with us every time we meet to make sure you're aligned for those things. Couple questions here, Scott. One specifically is, nowadays with technology and the quickness and access to information, a lot of noise is out there, right? And things we can hear on Monday can be drastically different by Friday. And we don't react to that because chances are it's going to be totally different. So, how do we think and how do we execute some changes we make in our portfolios based on some of this short term noise into a more strategic, longer term view, whether it be inflation or earnings or a number of different factors that could play in?
Yeah. It's a great question. That is one of the biggest challenges, the whole concept of identifying the signal or what matters out of this sea of information or noise. So for us, we are very much aware and attuned to what is happening and what's occurring in the world and in different areas of the world. What we do, though, is as we're assessing that information, we have a position already. They're expressed in the portfolios. And we're asking ourselves as new information occurs, is this something that is going to change our positioning or change our mind on our positioning? So, for example, when I mentioned that there is exposure to emerging markets, uh, part of that exposure is that we were underweight to that area of the world. We felt that that exposure benefits the portfolios. In or, what we'll do is we evaluate information. The question will be what would trigger us to underweight that. Right now, we see exceptional opportunities for longer term growth in those economies. They have been under-owned, which means less money has been going to them over the several years, partly because of underperformance. So we think that there's some longer term drivers of outperformance between the opportunity for growth in those economies, plus as investors may turn their attention back to them who maybe had ignored them. And what we're doing is paying attention to those longer term drivers. We're still assessing shorter term information, but paying attention to the longer term drivers to determine our positioning decisions.
Got it. And now, as we've kind of tried to anticipate what the Fed might do here over these next few quarters, if the expectation is potentially higher for longer with the rates, what bright spots or highlights of our portfolios or potential changes could we consider moving forward now? That could help with that.
Yeah, it's interesting because Monday of this week, that was the consensus view that we're likely to get, people were talking about a rate increase at the next Fed meeting, the 14th, I believe it was, softer print. So, and that radically changed the viewpoint of a lot of folks on Wall Street. So the point I'm making is for us, we do have some exposure to TIPS, Treasury inflation protected securities, which should provide some cushion if inflation continues to rise. If rates stay higher for longer, that's actually an opportunity. We have higher yields on the fixed income portfolios, so it's an opportunity for the fixed income portfolios to generate additional income. Rates moving up is typically not good for the price of bonds, but it is good for the yields of bonds. So depending on the pace of that rise could be beneficial. But at the moment, and we'll see if this week's print was a trend, it looks like the Fed likely will be not in a rush to raise rates. And for us, that means that we likely won't be making any positioning in response to the inflation outlook.
Okay. Um, Flipping to diversification real quick. Obviously, we talk about it ad nauseum sometimes, given that diversified is our name. I think we have a good sense of what diversification is, and I think a lot of individuals on this call here understand the foundation of our portfolios is diversification. But you also said, being diversified, not everything's going to go up, nor should everything go down at the same time. That's, given with diversification, but there's always going to be some piece of your portfolio that's probably lagging a little bit, right? So when we look at our asset class exposure and kind of our diversification across our portfolios, when you look at, say, an asset class like small cap that has been very underwhelming more recently, how do we kind of look, or how would you frame some of the weightings of these different asset classes in diversification that makes sense, even when one is not holding up its end of the
Yeah,
portfolio?
that's a great question because position sizing or the weighting, the exposure is a key component. The way that we think about it is that we look at the market overall and the weights to those different. So if you look at the market, a broad market index, you can segment that into large cap stocks, mid cap stocks, small cap stocks. So that gives you what would be a neutral weighting to a particular asset class. And then our decision becomes, do we want to be more than that, less than that, or neutral aligned with it? The reason for that, that's essentially the market's estimate of of what the appropriate weighting is. And then what we will do is determine based on attractiveness, and attractiveness can be valuation. Um, it can be based on growth potential. We'll determine if we would like to either be more than, equal to, or less than the market weight. What that means is that in the context of large cap and small cap, larger companies, and the weighting is done by the value of the companies, the market cap. So larger companies will make up more of the market. So we'll naturally always have more exposure to them. Smaller companies will make up less. So we'll have exposure, but it'll be much smaller in proportion. Those smaller companies will also give us one reason for diversification is that a different opportunity set, meaning exposures in different areas. They might be faster growing. They might be exposed to areas of the economy that maybe these larger companies are not. So it does two things. It gives us exposure to areas in other places, other opportunities to earn a return. And then our sizing is how we manage the risk so that we're not taking too much risk in any one asset class relative to what we would view as our neutral market benchmark.
Got it. Thank you. Thank you for that explanation. So that concludes our investment update for today. If anyone else has questions, feel free to reach out to us or reach out to your advisor, and happy to discuss more. The recording for today will be sent out to everyone here shortly, I believe at the end of the week or early next week, along with our monthly newsletter recapping some additional information. So with that, Scott, we appreciate the insights and look forward to our update in a couple more months from now.